and the markets stall. Very interesting adjustment here in market momentum, coming at a very auspicious time in the macro news flow narrative. This is, of course, Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to dig into here what it was that got these markets stuck, if anything, and what it means going forward, because we do, in fact, face the beginning of what will be perhaps something of a reckoning for investors. We stand now on this relatively quiet day where stock markets didn't do much of anything after a blistering advance, ahead of what is the beginning of a very interesting news flow cycle. One focused once again, as ever, on the Federal Reserve. Now, of course, we've spent a few weeks now dealing with what was a very sharp spike in market volatility and then the subsequent recovery. And so now we, of course, have a bit of room to consider other things, but the sort of active look at what the Fed is doing and why it's doing it seems to have almost fizzled away as the markets have really focused on why this particular market fell more than that one. Was it something having to do with Japan? What's the yen doing? Suddenly the carry trade became a regularly used phrase in regular civilian media, not even financial media. But now there is an opportunity to head back and say, okay, now that we've had the seesaw, now that we've had the breakneck volatility, what is this story actually about? And where does it go next? And as ever, the question here is, has the Fed now become worried about the economy? And with that in mind, we focus initially on what will be stage setting this week to answer that question, minutes from July's FOMC meeting. Now, at face value, this meeting was not the world's most eventful thing in the world looking at the price action. This is a 15-minute intraday chart. Each one of those bars, that is 15 minutes of price action. And as you can see right here, this is the opening of the international market day on July the 31st, the day of the meeting. So you can see overnight here, lots and lots of positive momentum for the benchmark S&P 500 here going into the Fed announcement. Once the Fed announcement itself occurs, you can see the markets have a little bit of follow through and then settle into a sort of slow digestive range into the rest of the day. So the announcement itself, not exactly a runaway influence this way or that. There's a bit of a pop, the markets digest, but all of the gains that they enjoy that day happen largely before the Fed ever says anything. This is not, as it turns out, a reflection of how much substance was on offer. Here's the policy statement here, and what we're showing is the changes in the statement from the June 12th policy meeting to the July 31st. And this is these edits are courtesy of the Wall Street Journal. What you see here is a very pointed adjustment in the rhetoric. So, job gains no longer remained strong. Now they moderated. The unemployment rate did not remain low. It moved up, but remains low. Inflation has eased, but remains somewhat elevated. Not just elevated, somewhat elevated. Perhaps the most important change in tone here comes at the bottom of this lower paragraph, where the Fed says the economic outlook is uncertain and the committee is attentive to risks on both sides of its dual mandate, which is, of course, a change from having just a month earlier said they are highly attentive to inflation risks. What does all this mean? The Fed has a dual mandate. The Fed targets inflation at 2%. That is how it defines price stability. And it seeks to achieve price stability in the context of maximum employment. That is to say, it wants exactly as much employment as it can possibly get without sacrificing price stability. When the Fed says it is now attentive to both sides of its mandate, very clearly dilutes its language on inflation fears and very clearly upgrades its level of concern about unemployment. What the Fed is telling us is something different from everything they've told us for the preceding year and a half. So why is it that the markets don't care or seem to have a relatively quiet response? Well, because the Fed isn't telling them anything they hadn't heard at that point. As it happens, this very rhetoric was put out into the world much earlier when Fed Chair Jerome Powell gave a semi-annual testimony in Congress on July 9th and 10th, and then shortly thereafter, in fact, the day after, we got the latest at that time set of U.S. CPI data, and it gave us an unexpected month-on-month decline with the data undershooting expectations. Then the markets absolutely responded, and we can see that indeed that was the top for the NASDAQ. That was starting to form the top for the S&P 500. Took a few more days there. And in fact, if we look at global markets, in the blue line down here is the All Country World Index, the global stock index from MSCI. And in the green is that very same index excluding the US. So just to make sure that the weight of US markets in averages does not overwhelm the direction, that index doesn't even include the US at all. Notice, the top in that index occurs with the Powell testimony. The index that includes the US and so has this slight few days extra from the S&P 500, that tops a little bit later. But critically, both the top in US markets and global markets occurs in early July, well before the Fed policy announcement. So what the Fed does here is it makes it official. But the change in rhetoric occurs much earlier. Why does the market take this to be concerning? Okay, so the Fed has been saying for ages that eventually getting in striking distance of the inflation target would mean, most likely, some weakening of the labor market. And the labor market has, until this point, until early July, generally surprised with how resilient it's been. Now, suddenly in July, the Fed appears to change its tune. And the markets say, wait a second, this is a source of serious concern. And when in the wake of this FOMC announcement, we also get that very same week. The FOMC announcement is on the 31st, which is that Wednesday. When we get a soft jobs report on August 2nd, that Friday, what do we see? Free fall. Which, of course, gives us that wild spike in volatility on August 5th, which you now see here across all markets in the US and worldwide. Why is it that the markets read it this way? Well, by the time the Fed changes their outlook, or at least changes the rhetoric with which they're discussing it, the markets are already looking at US economic data that has been slowly deteriorating relative to forecasts. Now, we can start to pin that right around here. This is the middle of April or so, and we can see, whereas here, let's call it from early 2023 until the middle of 2024, US economic data sometimes gets better relative to forecasts, sometimes a little bit cooler, sometimes accelerates, sometimes a little bit cooler. But as we can see here, we remain through this entire period above this zero line, which is to say, on the whole, US economic data is tending to beat expectations. The question is, by what kind of a margin? Are economic expectations tuned correctly? Or is the economy stronger than those expectations have it? We can see, for example, early 2023, the economy accelerates faster than is expected. Then those expectations are adjusted, get back to a reset. Then it accelerates again. We slowly come down to a reset. But this entire time, we are looking at data that is skewed toward beating forecasts. That all changes here, where we go in the middle of April and through now into a period where we get below zero. And so now US economic data is at a fundamentally different relationship with forecasts. Now the forecasts are pointedly too rosy, and the data continues to undershoot them. In fact, it is doing so from about mid-April, and certainly as we get into May, by an increasingly wide margin. So why does the market interpret the Fed's language change as signaling a growth concern? Because they've been watching the data tell them there is a growth concern increasingly over 4 months' time. Now, we know the markets respond to all of this and have been responding by looking at what they expect Fed policy to be. Here we are, mid-April. This is where the Fed starts to tell us inflation isn't falling fast enough. CPI has been getting kind of stuck. We know we said in March that there's going to be 3 rate cuts. Maybe we can't quite go as quickly because inflation isn't going our way. In other words, higher for longer. How do the markets respond? Well, we anchor around 1 rate cut for 2024, which is the gray bars. But as you notice, the outlook then for 2025 starts to expand out. So the total tally of easing expected from this year and next year, the orange line is the sum here, goes from about 76 basis points, so 3 cuts total for 2024 and 2025, to now, at the beginning of July, before we even get down here, at the beginning of July, when the Fed starts to leak out this communication, doubling that almost to 133 basis points. What does that mean? That the markets heard the Fed say higher for longer and said, okay, so this means you're behind the ball already. You are going to over-tighten. You are not cutting fast enough for growth dynamics as we see them. And so you're going to be behind the ball, which means you're going to have to cut more and faster next year, because what you're building for yourself is growth concerns. Consider what the Fed said in May. In recent months, there has been a lack of further progress toward the committee's 2% inflation objective. Fed doesn't want to cut. What did the Fed say in June? In March, we thought 3 rate cuts, 4.6 in 2024, down from 5.33. Now, just one cut from 5.3 to 5.1. So again, higher for longer. The Fed doesn't want to cut. What do the markets do in response? When the Fed says lack of progress in May, the next time they meet, the expected policy path is more dovish. When the Fed revises from 3 cuts to 1 in June, what's the next thing that happens? By the time they meet again in July, the Fed revises to a still more dovish setting. After the Fed says, okay, now we're worried about both sides of our mandate, what is the Fed saying? Okay, maybe now there's growth concern. The market revises still more dovish, which is where the curve is now. In other words, every single time over the past 3 meetings that the Fed has said anything at all about what it's going to do while not doing anything, the market has said, okay, here is another meeting where you've delayed. That means you're going to have to cut more later. Every single time. And so what we're looking at now, if we look at the overall setup, is as of July, when the Fed starts to unveil this rhetoric with that testimony on the 9th and the 10th, the relationship between the policy outlook and stocks fundamentally changes. Notice here, as things get more dovish, the market likes it. But as the Fed acknowledges the economic weakness, or at least appears to, the market goes, oh, they now are concerned about growth like we are. This means something is actually immediate. This means we might be flirting with recession already. And then as you see, things get more dovish, but now stocks don't like it. Now they're coming down. Notice that even in the entire rebound from those wild lows at the beginning of August, this relationship has been sustained. Stocks are going up as rate cut expectations cool a little, essentially signaling that data has been mixed enough, certainly with last week's retail sales being a notable mark for data outcomes that are significantly better than expected, unlike what is the overall dynamic. Even through that, we get a good is good, bad is bad on economic data as relative to the reaction from the stock market, because we are dealing now not with the promise of cheap money, but with figuring out the business cycle and whether growth is still on solid footing. Bad news was all good when it meant, well, the economy is fine, we don't need to worry about it, so bad data just means sooner easing for normalization reasons. It's a very different story when you are really concerned about growth, and now rate cuts signal something wrong has actually come into the immediate purview. This, of course, makes the minutes from this July meeting that made this change official a very important inflection point. Notice where we are now on the S&P 500. This is the Fed meeting. From then, the panic. This is the recoil from the panic, as if to say, okay, that was way too wild. This is way too far. We do not have this level of evidence of economic collapse or anything of the sort. Notice where we've stopped. This is the July top that we carved out with the Fed initially unveiling their new mantra. Here, we are back to these levels. And so effectively what we are now looking at is a bit of a reset. If the minutes here suggest that the Fed is indeed meaning what it says, that it has indeed developed a level of concern about over-tightening and about economic growth, the velocity of this sell-off might appear overdone, and the rebound therefrom might then appear reasonable. But the spirit of forming a top here, and the idea that cyclical concerns are now where the market's thinking needs to be, that will have reset and survived. So if we are to turn lower from here, perhaps even to slip back under the 5,600 level, this will look less like a momentary panic followed by a brisk recovery because nothing actually is wrong, and more like a preview of things to come. Perhaps not in terms of velocity, but in terms of direction. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean for what comes next. I am on with Victor Jones on Wednesdays for the price of truth, a mere 30 minutes after this show. I am on for Futures Power Hour with Chris on Fridays, back on with Victor Sundays, along with Tom for First Call at the start of the International Trading Week, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.